Be the end of the actions taken against Russia, and I can assure you Congress will want to weigh in as an independent branch on this issue.
Cardin says questions remain whether President-elect Donald Trump's Secretary of State pick, that's Rex Tillerson, can separate his role from his previous job as CEO of ExxonMobil. A North Carolina judge is temporarily blocking a new Republican-backed law that strips the incoming Democratic governor of his control over election boards. The judge ruled that the risk to free and fair elections justified stopping the law from taking effect this weekend. He plans to review the law on Thursday. Governor-elect Roy Cooper sued earlier today to block the law passed 2 weeks ago. Cooper takes office on Sunday. And at least 10 workers are dead and a dozen more may be trapped after a mine collapse in eastern India. Rescue crews are at the site frantically searching for survivors. Injured workers are being treated at a nearby hospital. The coal mine is owned by the state government but is leased to a private contractor. A U.S. Coast Guard official says crews are in search and rescue mode, not recovery mode, as they look for a plane carrying 6 people that disappeared overnight shortly after takeoff from a Cleveland airport along Lake Erie shore. The Columbus-bound Cessna Citation 525 departed Burke Lakefront Airport late Thursday night and disappeared from radar about 2 miles over the lake. So far, searchers have found no sign of any debris or the people aboard the plane. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg.
Live from Bloomberg's World Headquarters in New York, I'm Julie Hyman.
I'm Joe Weisenthal.
And I'm Oliver Rennick. We are 30 minutes away from the close of trading here for the year in New York.
And U.S. stocks are just off their session lows on the final trading day of 2016. After a turbulent start to the year, the S&P and NASDAQ are set for their best annual performance since 2014. Financials and energy, the biggest winners. No Dow 20,000, of course, but still its best year since 2013.
But the question is, what'd you miss?
Stocks are edging lower on this last trading day of the year. No Dow 20,000, but it's still poised for the best year since 2013. We'll take a look at some of the best and worst performing assets this year. It's been a wild 24 hours for the ruble following the announcement of U.S. sanctions and Russia's non-response, but the currency is poised for its strongest year ever against the dollar. And it's a question that just won't go away. Can the euro, the world's most ambitious financial experiment, survive? Brexit dealt a blow to the European Union this year, and the region is facing more political headwinds in 2017. Let's take a look now at where the major averages stand as we head towards the close, of course, not just of the trading session, but of the year. Bloomberg's Abigail Doolittle is standing by.
Indeed, Julie, going into the final 30 minutes of the trading year for 2016, we are looking at declines for the major averages. We have the Dow, S&P 500, and NASDAQ all lower in a noticeable degree, although off the lows, the NASDAQ earlier had been down more than 1%. But what does stand out here, this is the third day of declines in a row, the first time that's happened since the election. Plus, we're looking at weekly declines. In fact, this will be the first weekly decline for the Dow since the election. So a little bit of a bearish ending for the year, but what a great year it's been. This is a year-to-date chart of the same major averages. We see the Dow, S&P 500, and NASDAQ all up nicely. The Dow outperforming in a big way, on pace for its best year since 2013. Only 3 of the Dow stocks are lower on the year, while the Dow is really being helped by United Health, Caterpillar, and Goldman Sachs. Plus, we have the biotech bear market weighing to some degree on the NASDAQ and the S&P 500. As for the 10-year yield, it's been quite a year for Treasuries, quite a roller coaster ride, and we see this in this year-to-date chart. But overall, the 10-year yield has gained on the year 17 basis points. This is represented in red. It tells us that bonds are selling off. So while stocks did gain on the year, bonds sold off. But most of this, as we can see, is right over here in the final quarter. In fact, the 10-year yield has gained about 85 basis points this quarter, the biggest quarterly move ever after the election. Optimism around growth under the new presidential administration, plus as the Fed did raise rates. But the question is, going into 2017, will this move up continue? We hop into the Bloomberg and we take a look at #BTV. 2256. This is a great chart. We've shown it a couple of times, but it's a very important message. And what we have in white, we have the five-year inflation swap. This is a very forward look at inflation. In blue, we have the 10-year yield. This does come to us from Vincent Signorella, a Bloomberg intelligence strategist. And he says historically the swaps lead, basically the inflation leads. And this chart is telling us that inflation expectations have gotten ahead of themselves in the past, and it appears it could be happening now, too, that typically the 10-year yield shoots up through the five-year swap just as it's shooting down, and then both tend to drop back down. In fact, we have an area of congestion over here very similar to the past two that have led to declines. So we may see a bit of a reversal in the first half of 2017 of the big end-of-the-year move up for yields.
Thanks, Abigail. And we're about to talk to the aforementioned Mr. Signorella, in fact.
What'd you miss? Let's wrap up the best and worst performing assets of 2016. I want to bring in senior markets editor Mike Regan and Bloomberg's FX analyst Vince Signorella. Vince, let's start with you. Sure. End of the year. What's the number one thing you're looking for in 2017? What's the big thing you're watching?
I think it's going to be all about politics. I think politics actually really rule the day in 2016 with Brexit leading the way. I think politics is going to rule the roost going into 2017.
Mike, a lot of interest pretty much across all asset class. With politics, you follow the stock market closely. The funny thing to me is how, even if you knew the outcome of all the big votes this year, like election and Brexit, you probably would have gotten everything wrong because you would have probably sold off and bought a lot of downside protection that would have been worthless. What are you thinking about, and what do you have your eye on right now?
Well, obviously, you're right. I mean, it was sort of the death of conventional wisdom, both from what to expect from the referendum in Britain and the U.S. election, and also what the reaction would be. I mean, to me, it's amazing how quickly these dips were bought. Yeah. Clearly, sort of the quant funds, the algo traders are accelerating that buy-the-dip process. That said, as soon as you get used to that sort of rhythm, it makes you wonder if that's the end of it. So I don't know. I definitely, I think we'll all be watching Twitter possibly more than we're watching the Eco page to see what our new president is up to.
You know what I thought was interesting is that obviously you talked about those buy the dips. We had some pretty big events. We obviously had the first 2 months of the year were terrible. We had bounce after Brexit. We had sell-off going into the U.S. election. If you look at the VIX, the average for the year was actually lower than last year. It's right on pace. I mean, are we in really that different of an environment than what we're used to throughout the past 5 years?
I wonder if the VIX is maybe losing some of its power as a signal. There are so many different ways to hedge now. Yeah. One of the really crazy moves I was looking at was this ETF, the Direction Junior Gold Miner Bear 3 times index. It's basically an ETF that is triple short junior gold miners. It dropped 97%. Yeah. And then that was a great space to be in. So this is an ETF that dropped 97%. Yet, oddly, its market cap doubled over that time. So
people were still investing in it.
People were pouring, even as it lost 97%.
I think we have a chart of it, guys.
People were pouring money into it. And, there's a lot of examples like that of these sort of crazy exchange-traded products that are giving people a chance to hedge more.
I have that chart here right on the Bloomberg JNUG, the Direction 3X Junior Gold Miners ETF. Started the year at less than $3 a share. Went over $30 by the summer and is now around 5.5.
No, that's a different terrible one.
That's the long. That's the long ETF. If you do JDST, that's the short one.
We're playing dueling terminals on Friday. Wait, how does a stock's market cap go up? Explain to us, Mike, when the shares are basically flat.
They keep creating new shares. There's more interest in it. I mean, I'll tell you one thing. The thing is up 15% today. Still down 97% on the year. So I don't know how smart of money is playing this type of thing. It could be, a lot of pure gamblers out there. But there's a lot of products like this. So there's a lot of different ways to sort of focus your hedging now. And it makes me wonder if, the VIX isn't, the only sort of benchmark to look at for how people are hedging anymore. Yeah.
Vince, I got to bring in the ruble because of the news that we are talking about most recently, right? The ruble's been one of the big winners this year versus the U.S. dollar. Speaking of ETFs, the RSX, which also tracks Russian stocks here in the U.S., it's an ETF, is up a lot this year as well. what happens now with the ruble?
Well, the ruble's an interesting story. Obviously, it's gained because of commodities and crude prices. But from November on, we've had strong industrial production. Rates have come down. Inflation has come down. And now you've got this bromance with Trump and Putin going on. And if they patch things up, which seems like a real possibility, there is significant potential upside for the ruble to continue.
Is it hard to break out how much is commodities and how much is politics when you look at a move? And this applies beyond just Russia, because I think there's a lot of, you look at 10-year rates. How much is eco? How much is expected stimulus? Look at EM. How much is dollar tightening? How much is expectation of trade? How do you think about decomposing factors?
It's a really difficult question because I think most traders look at the excuse of the day, for instance, like what caused X asset to move, and you'll get all kinds of stories behind it. A lot of times those stories don't match up, but it's just the convenient story of the moment.
Getting back to stocks for a minute, when you're looking at all of these sort of out-of-the-blue factors, whether it's the effect on currencies, the effect on stocks and other assets, what are you hearing from investors in terms of the argument to be made for just buying an index fund, passive investing, et cetera?
Well, I don't think that's going to go away anytime soon. I mean, obviously, once again, we keep hearing people say that with this dispersion in returns, quote unquote, the return of the stock picker. I mean, people have been saying this for a long time and really sort of wishful thinking that active management will make this big comeback. The conditions are certainly there for the potential for it with, this return to value stocks and return to cyclical stocks and away from just, bond proxies and a wider dispersion. But, we'll see. We'll see how those returns come in if the active can start beating again.
All right. Excuse me. Really dramatic stuff got me coughing. Thank you very much, Mike Regan, Senior Markets Editor, and Vince Signorella, Bloomberg FX Analyst. Can't wait to talk to you both again in the new year.
All right, coming up, President-elect Donald Trump, we've been alluding to it. He tweeted his praise for Vladimir Putin after the Russian president said he will not expel American diplomats in light of new U.S. sanctions. We'll have the latest. This is Bloomberg.
What do you miss? President-elect Donald Trump is praising Russian President Vladimir Putin in a tweet today saying, quote, Great move on delay by V. Putin. I always knew he was very smart. This is in reaction to news that Moscow will not directly retaliate over a new round of U.S. sanctions against Russia. Let's talk about what's next for U.S. and Russian relations with William Pomerantz. He's the deputy director of the Kennan Institute for Advanced Russian Studies at the Woodrow Wilson Center, and he joins us now via Skype from Virginia. Thank you very much for joining us. So, Vladimir, Russia is not doing any sort of immediate tit-for-tat retribution to the expellation of 35 people by Obama yesterday. Is this simply just wait it out? There's no reason to do anything while there's, until a new administration comes in?
I think that was what was behind Vladimir Putin's decision. Clearly, he just has to wait 3 weeks. And instead of having a president who accuses him of espionage, he has a president who is happy to work with him and considers him a very smart guy. So why wouldn't he wait 3 weeks to see what the future holds?
At the same time, on this point at least, he appears to have a Congress that is not terribly willing to work with him, Trump that is, on this particular issue. How much of an issue, how much of a problem is that going to be?
I think it's going to be a major issue. Clearly, there are already prominent voices in the Senate and the House who have said that Obama's reaction was too late and not strong enough. So you're going to have a very interesting development of a president who wants to have better relations with Russia, having to deal with a Congress and his own party that probably wants tougher sanctions. I don't think anyone really can anticipate this particular battle because it will take place in the context of other major issues as well. So we just have to see whether the Republicans are willing potentially to work with Donald Trump and whether on certain issues they want to hold a hard line. We just don't know the answer to that yet.
Will, when we think about this entire situation that has arisen, obviously it does kind of feel a little bit late in the game. But what are sort of the next steps here? Because we talked to Senator Ben Cardin earlier, who basically said they want to take congressional sanctions as well. They want to push sanctions forward. Are they going to be able to do that? Are we going to be able to see more of this when Trump is in the White House?
I do believe that there will be a strong reaction to President Trump if the president-elect decides to remove the sanctions. And the Congress has it within its power to legislate the sanctions, to make them law. Right now, they are simply executive orders and can be implemented and removed at the president's discretion. So I think there's every possibility that if Congress doesn't like what Donald Trump does and how he decides to remove sanctions, whether he removes all of them or some of them, one can expect Congress to respond. And Russia is one of the few issues that unites Republicans and Democrats. So one would think that there is a very strong majority and potentially a veto-proof majority that can introduce their own sanctions in Congress.
William, Russia is not really seen as the militaristic power that it once was. Economically, it's significantly diminished, not a very big economic player on the global stage. But on the sort of modern, hyper-modern era of information, it seems to be very adept at using the tools of modern information. Theoretically, the administration says it's behind the hacking. It's very good at putting out information via channels like RT and Sputnik and so forth. How do Western countries deal with Russia's sort of novel use of, some would say, propaganda and dissemination of information?
Well, one hopes that the U.S. and its allies can find ways to counter them as opposed to potentially imitating them. Again, the crucial thing about Russia and what it's been able to do is that it creates its own set of facts, and it presents them in a very convincing way that convinces not just Russian audiences, but audiences in other countries around the world. So the United States and its allies have to find a way to counter that, but they have to do so at a time when their own political systems are subject to very populistic tendencies and are actually prone to listen to those types of arguments. So it's a very difficult process. It's unknown territory, and the United States has to figure out a way to respond adequately in order to be able, once again, to control the flow of information. And that's a very difficult thing to do in a very fragmented media space.
Well, it certainly doesn't seem as though these latest sanctions are going to achieve that, right, in terms of stopping any future hacks, for example. What would you suggest? How should the U.S. and other countries be dealing with these new kinds of threats and new kinds of issues?
Well, what the Russian response activities has shown is the U.S. needs to actually have higher cybersecurity standards and be on the lookout for these types of attacks and try to implement standards that defend the United States against these types of attacks. One should also add that when the FBI learns about attacks from other countries against the Democratic Party, one would assume that the FBI and government agencies take a more aggressive response, both in forming those entities and in articulating response back to the Russian Federation. So again, it requires greater security and also an ability to respond. President Obama has promised to respond. The issue is that a genuine response has to be secretive and not open.
All right, great stuff. Thank you. William Pomeranz, Deputy Director of the Kennan Institute for Advanced Russian Studies at the Woodrow Wilson Center.
From Culpeper, I might add, about 20 minutes away from my hometown. Don't see that very often. Up next, 2016 upended a lot of consensus forecasts. We'll break down where things stand for 2017 for a lot of major asset classes. That's the topic of today's Chart Chat. This is Bloomberg.
I'm Julie Hyman. What'd you miss? Well, 2017 forecasts. So we're looking at some different asset classes. I'm going to start with currencies because the movement in currencies next year is actually expected to be relatively muted versus this year, at least if you look out to the fourth quarter of 2017. So I used FXFC on the Bloomberg to look up the consensus forecast for next year, and here's what you get. Now, this is the year-to-date, the past year performance or so for the yen, the pound, and the euro. In the case of the yen, it's up 3% versus the dollar. The euro is down 3%, and the pound is down 16% versus the U.S. dollar. Now, for all of these currencies, the yen's forecasts are looking for 115, the pound 125, and the euro 107. So a little bit of a recovery for some of these currencies. But the movement in each of these is about 1.5% or so from current levels. So really not a huge move is what currency forecasters are predicting for next year. Although, if you look at the quarter-by-quarter forecast, there could be some more bouncing around over the course of the year. But interesting that it's kind of like for stocks. There's just not a lot of movement.
It's almost as if forecasters just look at the current market and then try to base their forecast based on that. And in fact, The chart I'm going to show makes a very similar point, but I'm looking at expectations for 10-year yields at the end of 2017. I mean, I think this is kind of the most important question of the year. What are interest rates going to do? If you get that right for the coming year, you're probably going to be in good shape. The average expectation for the 10-year, it's expected to close at 2.68% at the end of Q4 2017. But let's look at the trajectory of this, because it was below 2.2% in the middle of October, and then it immediately zoomed up after the election, and it's been zooming up since. I think we all know why suddenly people increased their forecast, because the underlying 10-year yield also jumped sharply during that time, and everybody had to scramble to adjust. I'm not trying to be cynical or anything like that. Nonetheless, that is where Wall Street sees the 10-year yield. Market-based measures of where rates are going, roughly the same place. Everyone seems to be coalescing around this 2.7 mark, a little bit higher than it is. Consensus is always kind of for higher yields. 2017, no exception.
You know who else bumped up their expectations for next year?
Who?
Stock strategists.
I wonder why.
All right, we're going to round it out. We got currencies, we got bonds. I'm going to talk stocks because there's actually some interesting stuff that's happened this year and that's also happening next year. But let's start about what's going on in 2017. Come right here and you're basically looking at what's happening for 2017 estimates. They're about 23.56 right now. So about a 4.5% gain priced into the market right now based on the strategists that we survey. But I want to actually give them some credit because they weren't so bad this year. If you actually look where the S&P is poised to end right now, it's at about 22.36. This is the estimate, the blue line right here. You can actually see it's pretty much flat, meaning that if indeed we do close where we are, which we have, then strats were pretty much on point. There's a caveat to it, though, and we talked about this a lot, which is, can you guess it? They're always bullish, right?
Right.
And this year in particular, they're always bullish. They're always on average about 10% bullish, meaning they think the S&P is going to go about 10%. Guess how much the S&P went up this year? 10%. So they were right on point. Did they call anything along the way? Not necessarily, but hey, credit where credit is due, and the average estimate was pretty close. So.
Well, it's interesting because we look at averages, right? Going into this year, there was a pretty broad dispersion of those estimates. For next year,
they're all right there together.
It's 200 points, 2,300 to 2,500.
Yep.
That's the range. That's it.
Any surprise there, and you're going to have a lot of people having to revise their estimates.
And I expect a lot of revisions, as in every year.
Yeah,
yes,
of course.
Indeed. The market close is coming up next, and here are the major averages. Less than 4 minutes until the close of trading on the day and on the year. This is Bloomberg. away from the closing bell. What'd you miss? Stocks near session lows as we close out the year. No Dow 20,000, but still the best year for the industrial average since 2013. The S&P 500 down for a third day, but still its best year since 2014. I'm Julie Hyman.
I'm Joe Weisenthal.
And I'm Oliver Rennick.
Welcome to the viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
And we begin with our market minutes on this last day of the year. Not a lot of superlatives for the day's session, but certainly quite a few for the year.
We didn't hit 20,000 this year.
We didn't hit 20,000. That's not one of them.
Didn't happen. I hope you didn't make any bets. I didn't make any.
Me neither.
All right. So let's start with stocks. It ended up being kind of an interesting last day for stocks. We were pretty deep in the red thanks to a couple sectors. The big ones, technology, about 20% weighting the S&P 500, down a full percent. Yeah, it ended up pretty bloody today. Consumer discretionary also down 1%. You pretty much had every sector except for financials doing poorly on the day. Financials ended up about 25 bips higher. What I think is interesting is that you've been seeing this trend where even when financials do well, you still have groups like utilities doing pretty well as well. So it's kind of odd. You don't have that sort of rate dispersion that you typically see. Then looking at a couple of stocks, there were some interesting movers today. We've been talking about NVIDIA. That, again, kept moving, this time in the down direction today. So it's gone back and forth. Overall, net down since Andrew left of Citron's short call.
But it's
not really
still
short call, a temporary short call.
224% on the year.
Right, there you go. So he's calling for a 90, so it's a little bit of a dip down, but not to zero as he usually does. Indo Health move up there today as well, and ConAgra pretty solid, or rather a down move there. So a little bit of red across the tape, as you can see. Finally, I want to jump to what we're going to look at here. We're going to be looking at the VIX, some volatility. Up on the week, 6 straight sessions of climbing VIX, despite stocks fluctuating back and forth. We're now at the highest VIX since November. Nothing to write home about, but watch it.
I don't know. I'm kind of with Mike Regan. Maybe we need to get
well,
rid
you know,
of
because you've got all these ETFs and stuff, and they have to balance out, so they have to buy those VIX options, and it gets pretty complicated. He's totally right.
All right, let's take a look at the government bond market. I want to start with the 2-year and the 10-year, looking at what they did intraday, both a bit lower on the day. And it's really interesting that U.S. 10-year yield is now back to where it was at that December 14th Fed meeting. You remember it shot right up after the not only did they hike, but the dots were kind of hawkish in the outlook. We've actually slowly erased all that, so that's kind of notable. Slight decline on the 2-year. Let's look at the 10-year on the 1-year basis to sort of give a sense of what kind of year has it's been. Pretty extraordinary. We got down to like 1.36, somewhere around there in July. July 8th was the exact low. It really started rising since then. Then you can see it having shot up right after the election, perhaps on expectations of more fiscal stimulus or something like that. So that sort of puts it in context for the year. Now, if we blow it out to a 10-year look, so we're looking at 10 years of the 10-year yield, we're still way off where we were pre-crisis. We got a long way to go. But we're climbing back up there. We're back to where we were in 2014 levels. So, I was saying in the last segment, I think the 10-year long-term rate's the key question right now. And there are a couple of charts to put it in context.
Is the 10-year your security of the year?
Yeah, I think so.
I think it's pretty solid.
Yeah. My security of the year.
Are we picking securities of the year? Is that a thing that we're doing?
We have to.
Uh-oh. Pressure's on. All right, let's take a look at currencies here. First of all, what they did in today's session. We got the dollar rising against the yen, but falling against the euro and the pound. But it's really the movement in the euro overnight that caused some fireworks in the currency market. Take a look at the Bloomberg. I've just got a 2-day intraday chart here of the euro. And what we saw overnight was this strange spike in the euro, right? This big spike here. And, if you talk to FX traders, they were saying it was sort of unexplained, algorithmic, computer trading. That's sort of the words they throw around when they don't know what exactly was going on. But this is something that has characterized the year as well. We've seen these strange spikes, particularly in currencies.
Yeah, a lot of flash smashes. There's, I think, something happened in Japan. Of course, the pound one from a couple months ago from October, always sort of at odd hours as well. And so that's why people blame the robots.
Right. And I also just quickly want to take a look at the returns on the year for some of the major currencies. WCRS on the Bloomberg. The real, the Brazilian real, the big winner against the U.S. dollar, up 22%. The rand as well. That would have been difficult to predict given some of the political turmoil there. The Canadian dollar and yen also having a positive return. The big loser, the peso, closely followed by the British pound and the Swedish krona as well.
There you go. All right, let's look at the commodities. Just let's look at two, oil and gold. Neither one moved very much at all today, basically flat. Let's get some perspective, though, on what kind of year it's been by looking at some one-year charts. I think we have a one-year chart of gold, maybe not.
Got a little gold?
Here we go, one-year chart of oil. I mean, we were back at 26 earlier this year. I mean, I think it's really extraordinary. The stock market and the bond market, pretty volatile years, but so wild with oil that it went through multiple bear markets within the same year. It looked like the world was falling apart for oil. Incredible comeback, closing near the highs of the year. And gold, another year of two halves sort of thing. It peaked in early July, which is, of course, the same time Treasuries peaked. So that whole trade of buying safety, buying safe haven assets, all peaking at that same time in early July. And much like Treasuries, selling off pretty dramatically right after the election, with a little bounce back in the last couple of days.
All right, those are today's and 2016's market minutes.
All right, Donald Trump, Brexit, and other political votes weighed on the markets in 2016. And 2017 is also expected to be dominated by politics. Our next guest will talk about some of these episodes and how they present opportunities to investors. Joining us now from London is Eric Lonergan, M&G Investments Fund Manager. Eric, explain, what are the big things to watch in 2017? We say this year was just so dominated by these key episodes. Brexit, Trump. Some people tried to hype up the Italy vote, maybe including us. That actually turned out to be kind of nothing. Nonetheless, that's really how this year, Fed decisions. So to you, what are like the big things you're watching in 2017?
Well, one of the lessons, I think, which is something that reoccurs in markets, but this year has really been a fantastic example of it, is in a sense that asset prices have a will of their own. Whereas we tend to try and focus on forecasting fundamental events. So the events themselves have been surprising, but I think in many ways the asset price response to those events has been even more surprising in many ways. And that's really where we try to focus our attention. So the irony is, if you'd had a crystal ball this year, it's not at all obvious you'd have made money, because the expectations and people's beliefs about what might have happened to prices in response to Trump or Brexit in particular, where the beliefs around the implications of Brexit were really quite traumatic. And the response of asset prices has been very different. So one of the things that we're always looking for is when asset prices themselves get to extreme points.
So in that case, then, and we talked to an investor yesterday who said this, do you just ignore the geopolitical stuff and focus on valuations and earnings, et cetera, and try to not even factor in those other elements?
Well, it's not so much that you don't ignore. So they're all very relevant. So there are likely to be fundamental consequences of those political events. But really what I'm saying is that you've got to be cognizant and recognize that asset prices, despite all of the science of risk management and the talk of fundamentals, that asset prices affect collective behavior, emotion, and psychology. And that's very, very important. So for example, a lot of what we spoke over the summer with you guys about was how it feels to own government bonds. And the point is, if you go to the point post-Brexit, when we just saw on that chart of 10-year yields, 10-year yields globally, government bond yields had got to such extreme lows after Brexit, people's perceptions were that these were incredibly safe assets. And then when you started to see them selling off and people start making big capital losses, their volatility rising, perceptions of risk, what it feels like to own that asset start to change dramatically. And that can result in much more amplified effects.
Eric, credit where credit is due. Your episode hedge fund kept up with the S&P 500 this year, outperformed by a tiny bit at the end there. Talk to us a little bit about what your expectations are for managing a multi-asset portfolio next year, because this year was pretty difficult. I mean, some of those returns, while sizable, were pretty limited to specific assets.
Absolutely, and to be perfectly honest, most of what was fruitful for us was a lot of transacting after what I would describe as these episodes. So these episodes are really phases when you get very rapid price moves, where markets become obsessed with a single story, and very often there's a very strong propensity for things to reverse. So, you know, if you go back to January or February when you had all of those scares about recessions, things like financial equity in Japan after the Bank of Japan moved to negative interest rates, those were, you know, opportunities that then reversed very aggressively. I think the big question for the next 12, 18 months is, in a sense, the moves that we've seen over the last 6 months in asset prices, the big moves, the big reversal in the bond market, big moves in some of the currencies, are premised on certain things happening. So I would describe the U.S. economy has really been in a state of sort of secular stability, I think, since the financial crisis, which is you've had this very, very stable rate of 2% real GDP growth, consistent payroll growth, relatively stable declines in the unemployment rate. And the interesting question now is, you know, will the change in policies associated with Trump really result in the economy shifting a gear? And I think that's going to be, and it's very, very difficult to call that, but that is absolutely going to have very big impact on asset pricing.
Do you think one of the lessons from 2016 is that you have to be more reactive, more quickly reactive than proactive when it comes to trading, whether it's a political event or some of these boom and potential boom and bust cycle to come?
I think that's absolutely right. So I think what's very important when you're thinking about investing is having a plan as to what you would do if asset prices move to, say, extreme levels, or if you see certain things occurring. So, for example, something that I think is a very interesting opportunity at the moment would be something like the Mexican peso. So, again, it's important to emphasize things that have already moved in a way that may be inconsistent with other asset prices, where you're getting very good odds. Your probability, the distribution of your returns is very favorable. So it is quite intriguing if you look at what's happened to the Mexican peso. So most of the assets that reacted initially very negatively to the association of Trump have pretty much reversed those initial moves, but you see something like the peso where you've still got the legacy of that volatility remains in the price. That kind of thing is very intriguing. So the way I would be positioned currently is you want to have balanced diversification, but you also want to make sure that you have significant room for maneuver, because as we saw this year, there are going to be lots of surprises in the next 12, 18 months. There are going to be lots of opportunities that one may want to exploit and take advantage of.
All right, M&G Investments, Eric Lonergan, you're going to be sticking with us. Next, we're going to be talking about more ideas for 2017. This is Bloomberg.
Next, let's get to the first word news this afternoon. President-elect Donald Trump has tweeted out a comment praising Russian President Vladimir Putin's decision not to retaliate for President Obama's expulsion of 35 Russian diplomats. Trump tweeted, "Great move on delay by V. Putin. I always knew he was very smart." Earlier today, Putin said he wouldn't be expelling anyone after Foreign Minister Sergei Lavrov urged that 35 American diplomats be forced to leave Russia. The Russians were kicked out of the U.S. in retaliation for interference in the presidential election. Activists are reporting the first death in Syria since a nationwide ceasefire began. The Syrian Observatory for Human Rights says a man has been killed by sniper fire in the eastern suburbs of Damascus, but there's been no word of major violations in the ceasefire brokered by Russia and Turkey. A federal judge has denied a request to delay a competency hearing for Dylan Roof. He's the white man facing possible death sentence in the killing of 9 African Americans at a Charleston, South Carolina church. Judge Richard Jergel ordered a psychiatric evaluation of Roof to take place this weekend in a hearing for Monday. In response, attorneys acting as the standby counsel asked for a delay, suggesting 1 week. The judge said no. Forecasters are warning of a high risk of wildfires in parts of the southern plains and in Florida thanks to gusty winds and especially dry air. The National Weather Service has issued red flag warnings for much of Oklahoma, southeastern Kansas, southwestern Missouri, and northern Texas. A warning is also in effect in west central and southwestern Florida, which has seen little rainfall in the past month. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg.
All right, we are back with M&G Investments' Eric Lonergan, who's staying late for us in London on a Friday here for New Year's Eve. We don't know if he's tapped into champagne. We assume not, but we don't know. Eric, so we've been talking to everybody about their sort of conviction trades for 2017. I want to ask you about something a little bit more specific in terms of how you manage your portfolio going into next year, because we were talking earlier on the show about the complexity of the VIX in terms of options pricing. I'm wondering, I know you've got a lot of different assets in your portfolio, but how do you think about hedging, and what tools do you use to do that in an environment that we're expecting to see like next year?
Well, I mean, we try not to typically, hedge for the sake of hedging. So ideally, we want all of the positions within our portfolios to make sense on a standalone basis. But we give material weight to how much correlation or diversification we can get across the asset classes. So, and I would view volatility using options in a very similar way. In other words, you should try to do them when they're attractively priced. I do think volatility is now at interesting levels in the case of the U.S. So if you look, I think beliefs about volatility, the absolute level of volatility is relatively low. Realized volatility, the VIX is relatively low, and not only that, it isn't very steep as a curve. So volatility itself can have a place in a portfolio.
Eric, I want to step back and talk about this idea of identifying assets that are at extremes, because it's obviously a very tough thing. You're thinking about something like 10-year yields, long-term yields. People have been saying, as long as I've been following markets over a decade, that yields just can't go any lower. I mean, I remember they were saying that in 2006. Like, okay, this is it. Yields just can't go any lower. So perceptions of what's extreme are very difficult to know at any given moment. And I assume that, that applies across all markets. What are some tools or heuristics or ideas that you use to actually identify when something is at an extreme?
Well, that's a great question, Joe. I mean, what I would say to you with respect to 10-year treasuries is I think there's an analytical error in a lot of those claims. So one thing I think is very important when you're thinking about government bond markets, and this is a kind of trap. So the short answer is I think you have to look at it asset class by asset class. But if I take your example of 10-year treasuries, one's got to remember that that's an expectation for a cash yield. So, one of the things that's kept our feet on the ground with respect to the government bond market is just looking at what are prevailing average cash rates. So it's quite surprising to people even now. So if you think to yourself, 10-year yields may look very low in the context of history, but the real question you have to ask yourself is it likely that the Fed funds rate is going to average more than 2.5% over the next 10 years? And you'll often find people's beliefs are very inconsistent. In other words, they think the level of 10-year yields is low, but they don't think cash rates are going to go higher than the 10-year, right? So, for example, it's interesting to look at a 10-year trailing average, just look at a 10-year historic Fed funds rate. The average has been sub 1%. So the reality is there's nothing about a new normal. We've been in a regime of negative real cash rates. So when I look at a 10-year yield now, 2.5%, that's a positive real return. That's not a silly valuation. If I look at currencies, though, I mean, this is something might be interesting to talk about, is look at something like sterling. I would say sterling against the dollar is at an extreme. And if you want to, you can just simply look at a 30, 40-year chart. And I think it gives a pretty clear message. And again, you can either look at that as a real exchange rate, which is not unreasonable, and you have to ask yourself some fundamental questions as to whether you really think, the relative performance of those two economies in some fundamental structural way has changed that dramatically.
So, Eric, you've mentioned the Mexican peso as being as an extreme as well. You've mentioned the pound, both of those presumably undervalued on a historic basis. Or is there anything you think that's on the other end of this extremes in terms of where you're looking for 2017? Anything that's gone too far in the other direction?
That's a good question. I mean, I guess that's tricky because I think a lot of things did look very overvalued around the middle of the year, and a lot of that is reversed. I mean, the obvious thing that people are concerned about is the level of the S&P 500, and I think that's a much sort of trickier debate because in an absolute sense, U.S. equities have done extremely well. I would say there's a reasonable degree of optimism now priced into U.S. equities. Valuations are above average, although the honest answer is that, average valuations don't have that high a degree of meaning. But I certainly think it's probably the relative opportunity. So I do think global equities and certain parts of the global equity market are looking a lot more attractive than the aggregate equity index. Eric, and within the aggregate equities, certainly the kind of staples or those rate-sensitive components, are just priced to deliver you poor returns.
Eric, real quick, is that your best trade, or do you have a top one for 2017, real fast?
I would say European equities and sterling.
All right, you got
against the dollar.
Nice speed. Enjoy your new year over there. That's M&G Investments' Eric Lonergan.
Well, coming up, where are volatility expectations the highest as we head into 2017? That's the subject of my chart in today's Deep Five, and you'll get these guys as well. This is Bloomberg. I'm Julie Hyman. What'd you miss? Well, in today's deep dive, I'm looking at volatility bets, not just with stocks. We've been talking about the VIX and whether it is as useful, but also other assets here. And we've been talking about dispersions and divergences, and this really stands out when you're looking at volatility expectations, tracked by a number of different indices. One, JP Morgan, that's currencies. The Bank of America one tracks treasuries. And so going into 2017, investors really appear to be looking at an uptick in volatility for currencies, treasuries, and gold. At the same time, they're looking at a drop in volatility for emerging markets, equities, and high yield. So it's kind of an interesting proxy as well for perhaps what might underperform and outperform for the coming year, but also, what traders are looking for in terms of how wild a ride they're going to have for these various asset classes.
That is a pretty striking divergence. I'm looking at something everybody is, of course, watching with utmost interest, and that is inflation in Spain. Just kidding. Probably most people aren't paying attention to it. But I think it's interesting because it speaks to this idea that the era of deflation around the globe may be coming to an end. In Spanish CPI, up now 1.4%, fastest pace since August 2013. So that's really a while back now. And it doesn't feel like very long ago when everyone was saying, where's there going to be inflation? When they're going to get inflation, deflation? And now no one says that at all. I think it was just a couple months ago people were still saying that. And so around the globe, you're seeing signs of price pressure starting to firm.
Nice. I like it. It's hard to find. It's still pretty hard to find inflation, right? So when you find some place that's got inflation, go for it.
You got to make a big deal out
of
it.
All right. My chart is looking at one of my favorite functions for the year, I guess. It's not anything particularly interesting today, but it's a great function that few people know about. It's IGPV. This is a great way, basically, to look at volume. Really on any security. I'm looking at it right now on the SPY just because it kind of gives you an idea what's been going on. This is basically your volume during the day. So this is broken up into 3 days right here. Let's check out what happened today. You can see the volume's actually been ticking above this orange line right here, meaning that your volume was actually a little bit above average of the 30-day. Then you look back yesterday, look at the day before, volumes have been pretty low. But the reason why I love this chart is because you can go in at any time of the day. You can see a strange tick up in stocks. You can figure out what was trading there, how big the trades were, and how it compares to any period, by the way, which you can change up here. We're at 30-day, but we can go to like 10-day. It's a great tool. I love it.
Lots to digest in that chart. Up next, as we tumble out of the last trading day of the year, we'll prognosticate about what lies ahead for global markets in 2017, particularly the future of Europe. This is Bloomberg.
Riggs. Let's get to the first word news this afternoon. President Vladimir Putin is condemning a new round of U.S. sanctions against Russia, but says Moscow will not retaliate by expelling American diplomats. Ariel Cohen is a senior fellow at the think tank Atlantic Council. On Bloomberg TV today, he spoke about President-elect Donald Trump's view of the situation.
What I think Trump is trying to do is to negotiate new understandings with Putin. He, after all, wrote The Art of the Deal. And the question Mr. Trump should be asking is, if we lift sanctions, for example, what are we getting back?
President Obama's move puts Trump in a position of having to decide whether to roll back the sanctions once he takes office. And the U.S. has released its most detailed report yet, backing accusations that Russian-supported hackers interfered in the presidential election. It's the first time the U.S. has officially and specifically tied intrusions into the DNC to hackers with the Russian civilian and military intelligence services. The 13-page report says Russia was involved in an ongoing campaign of cyber-enabled operations directed at the U.S. and its citizens. And Turkey's foreign minister is urging Washington and Moscow to put their differences aside and join in negotiations for a peace process in Syria. Mevlut Çavuşoğlu says the world does not need a new Cold War. He says neither side should expel diplomats over accusations the Kremlin interfered with the U.S. election. A ceasefire backed by Turkey and Russia is currently in effect in Syria. Democrats are preparing a case against Donald Trump's nominee for Treasury Secretary, Steve Mnuchin. They plan to accuse Mnuchin of preying on the middle-class workers that helped Trump win the race for the White House. That's according to a report in the Washington Post. Democrats will focus on Mnuchin's purchase of a failed subprime mortgage lender that has repeatedly been accused of wrongful foreclosures. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg.
Let's get a recap of today's market action now. We did see a little bit of a dip here to end the year, this continuing of the reversal, as people perhaps did a little bit of tax-associated selling here to close out the year. The Nasdaq doing the worst of the three major averages, down about 0.9%. Incidentally, the Nasdaq was also the worst of the three major averages on the year, up 7.5% to the S&P's 9.5% and the Dow's 13% gains, respectively.
What'd you miss? With the rise of populism sweeping Europe and the unity of the bloc at stake, geopolitical uncertainty risks roiling markets in the new year. But are people being overly fearful? I want to bring in Duncan Weldon, head of research at the Resolution Group. Duncan, you've been studying and following political economy across Europe for a while now, Greece, the UK, obviously. Is it just going to keep getting more and more chaotic, or is there any prospect of stabilization?
Well, Joe, I mean, 2016 has been quite a year for political risk, hasn't it? We had Brexit, which took the markets by surprise. We had Donald Trump winning, which took the markets by surprise. But I do wonder if now maybe people, shocked by the events in 2016 are starting to overestimate what really are still tail risks. So, the really big political event in Europe, the one that could really shake things up, that people are focusing on this year, is obviously the French presidential elections in April and May. And we should be in no doubt that a victory for Le Pen would be the beginning of the end for the European Union, the beginning of the end of the euro as we know it. But we should also take some solace in the fact that, all of the polls of the second round show Le Pen losing sort of 65-35, and that it's a very different electoral system to, say, the US. It's much more unlikely to produce this kind of surprise. So, I'm tempted to say maybe we are past peak populism, and I'm aware that the moment I say that, I could find myself on some sort of end of 2017 clip show of terrible calls for the year.
That's going to be embarrassing.
Well, but Duncan, didn't 2016 also show us that maybe populism, at least in the eyes of the markets, is not as dire as perhaps the predictions made it out to be? Because indeed, the two big populist events that we had, in one of the cases, the markets took a matter of, hours to snap back, and the other, it took days in the case of Brexit. So even if something like that happened in France, is there a certainty then that you would see markets tumble?
Well, there's never any certainty in these things, obviously, but I think, with Brexit, well, we had the vote, but obviously the process of actually leaving the European Union is only just beginning. It won't really officially begin until the end of March. But it must be said, the UK economy over the last 6-7 months has shown a great deal of resilience, a lot more resilience than many people, hands up, myself included, expected. There's a lot more forward momentum in that economy. So, we're not really seeing much of a direct Brexit impact on UK economic figures. And, on the market side, obviously the FTSE's had a very good year, up about 14%. Trump, that was one of the fastest reversals I can remember seeing in any market, where, the narrative just changed completely from America's elected a populist to, well, maybe fiscal policy is going to be looser, this is good for growth. And that took, as you say, maybe 5 or 6 hours for that reversal.
Duncan, let me augment Julie's point there just to kind of put a chart to it. I'm just bringing up right now on my terminal a chart of what's happened to 10-year gilts versus the volatility of the currency. Of course, it spiked after Brexit, but ultimately since September, vols continued to move lower. So I guess the question is, we've seen what happened with the populist victory and how markets responded. Brexit as well. What now, I guess, is the flashpoint in Europe that could potentially be something that not only is a geopolitical shakeup, but a market shakeup too?
Okay, well, I think the thing to watch this year, there's a lot of attention on the French elections, where I think the evidence suggests that a lot of Le Pen will make the second round. She's not going to win. There'll be a lot of worries about the Dutch elections we get earlier in the year, where the Freedom Party, the populist far right, may well top the poll, but under the Dutch system probably won't form a government. In Germany, Alternative for Deutschland will no doubt do better than previously, but Merkel will win. The one to watch where something, we could get a nasty upset is Italy, where we may get an election in 2017. Italy's a very particular case where you don't just have one bunch of anti-Euro types, the Five-Star Movement, but also much of the old Forza Italia party is also, against the Euro. So, so there are two potential sources of an Italian government which could find yourself in a standoff with Europe. But we should think back to Greece. It's worth saying, here's the new year, we're looking at existential threats to the euro. Well, déjà vu. Almost every year seems to start with a different list of existential threats to the euro.
I want to ask you about Greece, but I want to take a slightly different angle on it, because one of the things thinking back to Greece is that obviously the Syriza government, pretty far-left radical, but then when they came to power, they had to deal with the institutional constraints and the facts as they were, that they just didn't have the flexibility really to do what they wanted to do while staying in the Eurozone. Now, other countries aren't quite in the same position. They don't have the situation where they're such at the mercy of borrowers. That being said, there are still bigger institutional constraints. It's not quite as easy to just turn around the direction of a country as maybe people would like to imagine. When you think about how these new leaders, like the UK post-Brexit, Donald Trump and so forth, are they going to be bound by... Are they going to be more bound by various constraints in the international and domestic order than perhaps their supporters realize?
Oh, absolutely, because this is what happens to new governments, but I think that's particularly the case for Eurozone members. Being a member of the Eurozone means you've given up a lot of macroeconomic flexibility, you've given up a lot of other types of flexibility too. You certainly saw that in Greece, where you had that very angry 5-6 month will they, won't they standoff before eventually they agreed to another series of measures with the Troika, and 18 months on, the economy is not in a great shape in Greece, but the immediate idea of a Grexit, it's a word we don't use very often anymore, that you get bound in by these constraints. I think the thing about the Eurozone is, the Euro's been there 15, 16 years now. The Euro has in many ways been economically disastrous for much of Europe. It's an incomplete monetary union on what's not an optimal currency area. But although it's been economically a disaster, it has also been incredibly resilient. There are so many times in 2011, 2012, 2015, now again in 2016, there have been these big political threats, but each time they've been managed, and each time when the final crisis comes, when push comes to shove, the Eurozone's political leaders have done just enough to keep the zone together. And the thing we should remember at the Euro is, we tend to analyse it because it's a currency as an economic phenomena. But it's as much political as anything else. This was, about European unity, about the unity of the continent. And in the end, the political leadership of Europe have always done just enough to keep it together, because there is a hell of a lot of political capital tied up in holding that currency union as it actually is.
Of course, one way they have not kept it together is that the UK is indeed leaving. What are you expecting this year on that front as Article 50 is triggered, as the exit is negotiated? What are you expecting there, and what effect do you think it's going to have on markets?
Well, I think 2017, in terms of what we actually know about Brexit, we're not going to know a great deal more. We'll get Article 50 triggered by the end of the first quarter of this year. There will then probably be a 5 or 6 month delay before the actual talks get started. We'll wait until we're beyond the French elections, beyond the German elections. So it'll be towards the end of 2017 before really detailed talks get underway. And of course, the thing about trade agreements, and this is best thought of as, it's the best analogy we have, is they say in trade agreements nothing is agreed until everything is agreed. And I don't think it's going to be a gradual process of, we learn that an agreement has been done on, say, customs duties. That's checked off. We move on to the next issue. Maybe that's migration. I don't think it will be like that. I don't think we will actually know what the final deal looks like until towards the end of the process, really more into sort of late 2018, early 2019. So I think it's going to be a lot of uncertainty next year. Brexit just rumbling on there in the background, and there's still, there will still be this uncertainty, and there will still be a substantial, premium, an uncertainty premium, a risk premium on UK assets hanging there at the back.
All right, Duncan Weldon, head of research at the Resolution Group. Thanks for coming in late on a Friday. Appreciate having you on. Looking forward to talking to you in the new year.
Well, coming up, the outlook for grocers and mass merchants as Amazon aims for the food retail space. Here's a look at how some food retailers have done this year. Grocers, as we also call them. Kroger, Whole Foods, and Sprouts all tumbling on the year. This is Bloomberg. What'd you miss? Bloomberg Intelligence has released its 2017 outlook, and each day this week we're taking a look at what you can't miss in various sectors for next year. Today, looking at food retail and mass merchants. And joining us now is Bloomberg Intelligence analyst Jennifer Batashis from our Princeton office. Jen, thank you again for joining us. First of all, we have seen many of these consumer staples, grocers, not do so well since the election, as we've seen a rotation out. One of the things that people appear to be looking at next year is the potential impact of inflation on some of these companies. I'm curious what your take is. Are their margins going to get squeezed, or are they going to be able to raise prices?
Yeah, so going into 2017, we're still in a deflationary environment. And so for the food retailers, that means that gross margins will stay under pressure, sales will remain pressured. But the good news is that we're starting to cycle over some of the worst of the deflation, and that by the second half of the year, we should see things start to get a little bit better.
So a few stocks that we just ran through before the break, look at Kroger, you look at Whole Foods, Sprouts, they're all in the red, but some by more than others. The Whole Foods story seems like they kind of got ahead of themselves in assuming who is willing to pay the prices that they charge. But the big stores, how come they're having so much trouble?
Well, you know, part of what's happening is there's really a shift going on in terms of consumers and what they're really looking for. And so what you're seeing is that people want to go to smaller stores, have faster shops, they want to be able to stay on a budget, and they want retailers that will engage with them in some sort of digital way. And so when we look forward to 2017, the companies that are likely to do better are those that are keeping all of those things in mind. And so even though they ended the year on a weak note, a lot of that was deflation related. And hopefully going forward into 17, you'll see a little bit more of that consumer engagement taking place.
One nascent trend in the food world is meal kits, things like Blue Apron, people buying groceries as part of a package all together just for one meal. Is that moving the dial at all yet in terms of how people buy groceries, or is that just too niche to matter at this point?
So far, it's fairly niche, but what we're seeing is that a lot of the retailers are starting to put together those kind of packaged meals in their stores. So rather than try to go into a business where they're shipping to someone's home, you can go into an H-E-B, you can go into a Whole Foods, you can go into a Kroger, and you can actually get a meal kit very similar to what you would get from Blue Apron and take it home and feed your family.
Jennifer, do these services, are they popular outside major urban areas? Because obviously it appeals to the New Yorker and has to get just stuff delivered from Amazon Fresh or Peapod or whatever. But what about people that live outside of major urban areas? Where is the sort of the breadth for the user there?
Well, once you get into the suburban areas, the real growth in retail for online grocery is in what we call click and collect. And that's where you order online and then you go to the store and you pick it up yourself. So what that does is that really hits a sweet spot for customers and for retailers, because you still get things very convenient. You don't have to go into the store. And yet for the retailers, they don't have to pay for the delivery charges.
Of course, the upstart, as it were, in that business, although it's quite a big upstart, is Amazon, right? With Amazon Fresh and the introduction there, Amazon has obviously disrupted some other types of traditional retail. Is it time for it to happen in food?
Well, it's slowly starting to happen, and you see Amazon making some interesting noise around food retail about opening stores with no checkout lines that people can simply walk in and take and use their smartphone and walk out the door. You see them talking about having pickup points for that click and collect service that I talked about. But on a realistic basis, it'll take quite a long period of time for Amazon to really be able to change the behavior of most shoppers. Most people still want to go, they want to pick out the fruit themselves. They like to browse while they're in the store, and that behavior will take a long time to change.
What does 2017 hold in store for Walmart's grocery business?
Well, you know, Walmart is the largest food retailer in the United States. They sell over 50% of their revenue is coming from food. And they've had a lot of intent to really revolutionize that business. They've been getting better at fresh, they've been getting better at having things in stock, and they've been rolling out click and collect very aggressively. If they can continue on that path, they have the ability to really lock down some additional market share going into 2017.
All right, Bloomberg intelligence analyst Jen Bartashis. Jen, take two went very well. Thank you very much. We had some technical issues with Jen earlier in the week, so thanks so much for coming back.
Up next, Amazon isn't just competing with grocers and mass merchants, it's also looking to dominate the market for voice-activated assistants, and that's something rivals like Apple and Google can no longer ignore. This is Bloomberg. Amazon's surprise hit of 2016, the Echo speaker helped the online retailer report its best holiday sales yet. Demand for the AI-powered smart speaker proves there's a lucrative consumer market for voice-activated assistants in the home, something that Google and Apple can no longer ignore. Bloomberg's Caitlin Meehan reports.
The top 5 most valuable tech companies in the world are all betting big on the success of virtual assistants that respond to voice commands. The race really started with Amazon's surprise hit, the Echo. It's powered by a digital assistant named Alexa.
Alexa, how many championships has Dan Marino won?
Dan Marino has won 0 championships.
Alexa, how many Oscars has Alec Baldwin won?
Alec Baldwin has won 0
Alexa, stop. Well played, Marino.
Echo debuted in mid-2015, and by April 2016, consumer researchers reported that Amazon had already sold more than 3 million devices. And it was cheap, selling for the relatively low price of $180 a pop. But the real payoff was in Amazon's core e-commerce business.
We think it's one of the faster growing businesses for Amazon, and more importantly, it actually adds into the ecosystem that Amazon has, where they already have a bunch of traffic coming to their website. But this is a chance for Amazon to grab the traffic, which is not online.
Echo owners are spending an estimated 10% more time on Amazon.com after buying the smart speaker, and Amazon stock has popped more than 70% since the Echo came out in the U.S. So it's no surprise Google wanted in on the action.
Credit to the team at Amazon for creating a lot of excitement in this space. We've been thinking about our own unique approach, and we are getting ready to launch something later this year.
That something was Google Home. It hit the market in October, priced $50 less than the Echo, and loaded with Google's own conversational interface, which leaves us with the elephant in the room.
Hi, it's me. It sure is great to be on the Mac.
Apple's assistant Siri has been out for 5 years now, since it debuted on the iPhone 4S, but its use has been mainly limited to the iPhone, which could be a problem for Apple. Because by some estimates, only 23% of U.S. smartphone owners actually use voice assistants like Siri on a weekly basis.
It's so important of a category, and Amazon has so proven that there's a customer demand and that it's a sexy new kind of interface for information that Apple would be insane not to get out there with a product that's similar. But it's all about the implementation, and it's also going to be a real disadvantage not to have been first.
But then again, Apple wasn't first to the smartphone or the tablet market either. And back in September, Bloomberg reported that Apple is in fact pushing ahead with an Echo-style competitor. So, we can only expect this market to keep growing in 2017, with IDC forecasting shipments jumping 130% to 21 million.
It is time now for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. Few companies matched JP Morgan's 30% stock performance this year, but even fewer corporate executives followed the example of the company's CEO, who shelled out almost $27 million for his company's shares this year. Most corporate executives and directors steered clear of their own stocks as they became increasingly expensive, but not Jamie Dimon. At 6 of the 10 companies with the most insider buys this year, the chief executive was the single biggest purchaser. President-elect Donald Trump's White House victory has driven up the expectation for higher bank profits. Still, analysts at Morgan Stanley say that won't keep Wall Street from cutting more jobs next year. They say banks will keep chipping away at costs by using technology to replace traders and branches. And a polar blast is poised to sweep the U.S. in the new year, and it's pushing natural gas futures up the most since the shale boom began a decade ago. According to the Commodity Weather Group, frigid air will sweep the western two-thirds of the nation January 4th through the 8th, stoking demand for heating. The deep freeze comes as output from shale basins slows, sending production toward a second straight annual drop. And that is your Bloomberg Business Flash.
Coming up, the What You Missed team is gearing up for 2017. We're doing a little something different today for Don't Miss This. Our New Year's resolutions coming up. This is Bloomberg. Don't miss this. Our New Year's resolutions. My New Year's resolution is to be nicer.
What? I was going to say
Oliver.
That's the opposite of mine. I resolved to get into a lot more fights on the internet because I think that's very healthy behavior.
I'm going to do my best to not hack any more national elections. Oh, I didn't realize we were on air. Yeah, I'll be nicer too.
All right, have a great evening. You're looking at the year-to-date results for all the big indices behind you. Have a great evening. We'll see you in the new year. This is Bloomberg.